Okay, peeps, welcome back. So today we're going to be talking about how to retire quickly with these three high yielding ETFs. Let's get it. So, which three high yielding ETFs am I talking about here? Well, the first one is KLIP, which is the KraneShares covered call ETF. It's basically China internet stocks or companies, some of the biggest, basically the equivalent of the biggest tech companies in China in comparison to the US. It would be like the Chinese Google, Chinese Amazon, something like that. So that would be the first one. The second one that we're going to pick is Coney. Reason being is because Bitcoin and Coinbase are heating up as of recently because there's talks of a BlackRock spot Bitcoin ETF coming out. Now, whether that's actually going to happen or not, that remains to be seen, but it seems that they are taking steps in that direction. So if we scroll down here to crypto, you guys can see that this thing has really been taken off. So a lot of green in crypto. Bitcoin's up huge. As you guys can see, though, with stocks, with swing trading or growth stocks and dividend paying stocks are getting kind of pounded pretty heavily as of recently. August and September has been pretty bearish, but we'll have to wait and see how the remainder of the month plays out, and also what the end of the year is going to look like. So you guys can see that Coinbase is down a little bit, but if we actually take a look at the bigger time frame on Coinbase, and this obviously relates to Coney because Coney is based on Coinbase, you guys can see that basically from June, July lows, we're up pretty huge. We're up about $30 a share, so almost 50%. And the last one would be the QQQY, which is based on the NASDAQ. And if we click on the NASDAQ real quick, so this would be the actual NASDAQ. It's not the futures version. You guys can see that basically since the start of the year, we are up pretty huge, but we are kind of down on the NASDAQ too. As you guys can see, it's kind of slowly trending down. Basically, we need to see a break above this downtrending line right here. And then, yeah, we should start to see some massive upside, and then QQQY should be going up with it. So for KLIP, the dividend payout as of recently is 74 cents a share. That's probably going to go up because KLIP has been going up in recent months, or recent weeks, I mean. So if we take a look at the price of KLIP, you guys can see it is down a lot. But if we go over here to the daily, and again, these options, I believe, are traded on a weekly or a monthly basis. Not really sure which, but they're relatively short time frames. So you guys can see from the low to the high here, we have had a pretty substantial swing up, so about 3.47%. We go over to Coney here. You guys can see they pay $1.20. Coney currently, as of right now, is roughly about $20 a share. You guys can see it's kind of vacillating between this range. So ideally with the BlackRock spot Bitcoin ETF and Coinbase moonshotting, that Coney would also go up as well. And the QQQY, we already went over that one. So unfortunately, QQQY is down a little bit. But, you know, as dividend investors, you don't necessarily really care about the price. You just more or less care about the passive income. I mean, obviously, a price appreciation would be important. It would be good, right, for prices to go up. But we are kind of still in a Fed tightening cycle until the Fed starts printing money again. Well, might just have to deal with the chop, unfortunately. So let's get into the numbers. As you guys can see here, we have the three different ETFs pulled up. We have KLIP, Coney, and the QQQY. So this one, we're basically going to do this one. It's a ETF. Not really sure why it listed as stock here, but distribution is monthly. We're going to reinvest the dividends. We'll start out with 50 shares. You know, it's roughly $1,000 or less on each of these. Most people that invest in securities could probably afford that, I would say. Share price $17.22. We'll start out with an annual contribution of $500 a month. You got your tax rate. Here's the annual dividend. So no dividend increase. This is, of course, we're speculating here. We don't really know if it's going to increase or not. when the price goes back up, it could definitely increase. We could see $1 a share again. That's absolutely possible. Share price appreciation 1% per year, and years invested would be 10 years. So, kind of the thesis that we've gone over in previous videos is if you make $5,000 a month in passive income before taxes, or I'm sorry, after taxes, that's considered to be a pretty good income, right? So if this is all you did with just this ETF, after 7 years, you would be at that roughly $5,000 a month after taxes. So you get 70,000 before taxes, assuming that your tax rate is roughly about 20%. You're going to pay about 14,000 in taxes, so you'll walk away with about 56,000 in net income. It's not quite 5,000 a month, but it's pretty close. But the general idea here on this is we're not trying to get to $65,000 a year on one ETF. We wanted to use a combination of these three. So pretty much what we're looking for here is for the after-tax amount. So we need to make $65,000 a year, $5,000 a month, which hold on a sec. So $65,000 a year times 20%, so 13,000. So we actually need to make 78,000 before taxes. We divide that into 3, so we need to basically make 26,000 a year with each one of these ETFs. So in year 5, we would be at the $27,000 a year mark here. And if we go down to Coney, you can see there's actually a pretty substantial difference here, because the payout for Coney currently is much higher. But as you guys can see, in year 4, we get to that roughly about $26,000 a year in year 4. And with the Defiance ETFs, QQQY, you guys can see that we get to roughly about that number also at year 4. Now, the process of this could actually be accelerated even faster than this. Here's why I say this, because we're only putting $500 a month into each. If you wanted to go ahead and put, let's say, you want to put in $1,000 a month, which, I'm not sure how many people can take $3,000 a month and put them into dividend paying stocks, but if you can, fantastic. That's great. So we're going to go ahead and switch each of these to $1,000 a month. All right, now with that being said, let's take a look at the results. So we have basically the same metrics here, but we're using $1,000 a month instead of $500 a month. So the goal, once again, is to get to $26,000 per year in passive income from each individual ETF. Okay. So in year 4, you'd be well past that marker here. And on the Coney ETF, scroll down and take a look at this. You would actually be there by year 3 on Coney. And for the QQQY ETF, you would basically more or less be there roughly also by about the end of year 3 on QQQY. Now, one thing that you guys could do to actually accelerate this process, if you wanted to, is you could basically take whatever you're getting paid in dividends plus your active income on the payment date, and you could roll it into the ETF with the next closest ex-dividend date. So what do I mean by this? Well, we're going to figure that out now. So let's say that I was going to get paid a dividend from KLIP. So KLIP, as you guys can see here, the X dates are on the left, the payment dates are on the right, and then you have the amount just on the right of that. So if the X date, well, we're not taking a look at the X date right now, but if the payment date is on October 31st, 2023, that means that we would get paid from KLIP on October 31st, maybe on the 1st. It depends on how much lag time there is. However, let's see if I can actually find it here. So we'll go over to the yieldmax ETF distributions here. So I believe the next one would actually be QQQY. So basically, we would take the dividend payment from KLIP plus the active income, and then we would turn around and roll it into the Defiance ETFs. But notice how the payment date on KLIP and the X date on the Defiance ETF Triple QY are only a day apart, well, most likely it wouldn't work in this particular scenario to roll the clip dividends into triple QYs. So probably what you would want to do instead is take the clip dividends and the triple QY dividends, and in this case, roll plus your active income and roll it into the yieldmax ETFs. So you would basically take your payouts on the 31st and the 1st, roll it in before the 8th, plus be buying with your active income. And then you get your payment date here from the yieldmax funds on the 16th, which you could then use to buy in before the X date on December 1st on triple QY. And you could use it to buy into clip before November 28th on the X dividend date for clip. So the general idea here is that the compounding effect, the compound growth, I should say, the dividend snowball effect takes place over time, and it grows your investment. But think about this for a second. If you're only putting the dividends from one investment back into that same investment on a monthly basis, that's great and all. And it does compound over a monthly time frame, gives you more time to accumulate those shares within the same month. However, if you're getting paid 3 separate dividends within the same month and you're able to basically move funds or move the dividends plus your active income from one investment into the next investment with the same month, your dividend snowball is effectively creating what I like to call a double dividend snowball. So it's actually accelerating the rate at which you increase your income even faster. And we have tested this personally as a strategy that we would use to grow our dividend passive income. So we can tell you that it works. I believe basically we took like an entire month. So not these particular ETFs, but some other individual companies or ETFs that we hold. Like I can show you guys right here actually on TradingView. So some of the ones that we tested them out with was basically, I believe in September or August, something like that. So we took a number of these ETFs. We wrote down on a piece of paper what all the X dividend dates would be, and we basically tested this out for ourselves. So we took the active income plus the dividends from whatever we were getting paid and moved it into the next fund within that same month before the X dividend dates. So some of the positions that we used, excuse me, would be Horizon, OPP, RIV, PDI, PFLT. I believe we used QYLD, ACP, BSTZ was one of them, and RA. We used RA, and we also used TLTW. So these are just a few that we used. So we had I think 16 to 20 different positions on the piece of paper. So we were only able to invest before the X date of each within a few days of each other, but we did notice that the following month that the payouts increased substantially. So by using this strategy in this particular way, you could probably, I would say theoretically, cut down the amount of time it takes to get to these numbers here by probably at least 6 to 12 months. Don't quote me on that because there's not a calculator that we can use to test this theory out. But if you're growing your dividend income 3 times as fast every single month, then theoretically it would triple, or it would cut down the amount of time it takes by that amount, right? To basically get to a point where you can grow these even faster and get to these numbers. So anyways, we hope you all enjoyed the content of this video. Please let us know your thoughts down below. Whether you guys think this is a good idea, not a good idea, whether you plan to implement it, plan not to implement it. Again, we're not shilling these ETFs. We invest in these, but do your own due diligence and research. Understand what you're getting into before you get into it. It's just common sense stuff. But anyways, hope you all enjoyed the content. Please like, comment, and subscribe, and we'll see y'all later. Peace.